Well. What do we got here? If you're not around and you seen something strange happening to the Netflix stock, it went up 15.5% in one day, which is something rather unusual, I guess. But what happened then? What was something nice and fascinating that happened to Netflix? They had a very great quarter. So after they announced the crackdown on the password sharing, revenue of the company boosted up to $8.54 billion, which is equivalent to 7.8%. And of course, it also boosted the net income to 1.7 billion and per share to the equivalent of $3.57. That sounds finally very good for the company, especially when it was experiencing some rather tough times. So if you can see, it was in very bad shape in December 2022. Then it skyrocketed with a lovely bull run until August 2023, and then it went down. And it looks like that the company was just getting a beating. Um, but what's happening and how to identify whether this growth is actually sustainable, whether the company would be able to follow the same path and keep on going in the right direction. For that, let's have a look into our tool. It is called 930 spreadsheet tool. So this is pretty simple. So you can just input the ticker symbol in the exchange, and then you will see all the relevant information about the company in terms of its finance for the past 5 years. As you can see here, yeah, indeed, six company foundation principles are there. However, only three of them are green. So the company is having the revenue growth, net income growth, and the free cash flow growth in the period from 2018 to 2022 up until now, pretty much. However, when it gets to long-term debt, the company is it accumulated some debt, let's say. So if we just skim through the company real quick, if you're not familiar, Netflix is a powerhouse when it gets to entertainment. It's pretty much the 21st century TV. So if you do not have Netflix, I would be actually surprised, especially if you live in Europe or in the US. So yeah, if we move on to the statistics about the company, then we can see that the net earnings are gradually growing, but it's on par actually with the market. So as you can see, it's presented in yellow. The same with the net interest expense ratio. R&D is also actually not that bad, considering the fact that the company actually needs to spend quite some money in keeping updated their platform. When it gets to the selling and general expense, it's also not that bad. However, when it gets to depreciation and gross profit margin, it's rather high, so it's always above 100%. The reason behind it, I assume, is that because of the nature of the, let's say, the products it provides content, and the way how you value content and then depreciation on it is probably rather complex. I am not a professional when it gets to that. However, if you would be willing to further investigate purchase of Netflix stock, this is probably something to consider. How do they do the calculations of depreciation and why it's so high? And another problem is with Netflix is because of the fact that the company actually needs to produce content on its own. The plus is that it's actually being secured in terms of not being dependent on the content of other companies, like for example Warner Brothers, Disney. So they are self-sustainable. However, this also affects their free cash flow, as you can see. So the free cash flow per share outstanding was always negative apart from 2020. So when was COVID hit and people were just pretty much sitting at home and they had nothing to do, so they could spend money on Netflix subscription. And up until recently in 2022, so when the company actually had to impose some measures to manage their expenses more accurately and increase its revenues, meaning, for example, the crackdown on the password sharing. was introduced. And yeah, you can see the same results reflected in the free cash flow grow, revenue grow, and net earnings grow. This is always fluctuating, so you cannot really see any, let's say, consistency when it gets to that. So the company invests a lot in generation of its content, in driving the revenue. However, when it gets to the having healthy and stable free cash flow, this is hard. This is just hard for the company. So this is also something to keep in mind. Luckily, at least, the company does not dilute you. Maybe just a little bit fractionally, but like, let's say 1% a year. It's not that big of a deal, luckily. And also important to keep in mind, as you can see, the company does not pay a dividend. So if you're a dividend investor, yeah, Netflix definitely is not your choice at the moment. And as you can see here, when it gets to the Fundsmith investing ratio, so these are, let's say, some of the key metrics which Terry Smith, the famous British fund manager, looks into. And this is something we also try to have a look into in order to assess the health of the financials of the companies we would like to invest in the future. And yeah, this is also a little bit messy, so something else, also to consider in the future. But the question is now, we have seen the results for the last quarter, we have seen the boost, but the question is it actually sustainable in terms of growth? Number one. And second, is the current price of $400 is actually the right one to pay for the stock? So in order to understand that, we just move on to the last portion of our tool. So as you can see here, there are some of the orange inputs which you need to fill in. So when it gets to the future growth rates in percentages, you can either assume it yourself, or you can, for example, check different sources. Like, for instance, it can be either attributed to the free cash flow growth or the revenue growth. So if we go to a tool, for example, stock analysis, right? And if we take, for instance, the revenue side of things, we will see that the company is growing with about 25% rate annually, which is insanely good. However, it is also important to see and to highlight is that the growth is actually decelerating every year for the past 5 years. So before it was in mid to low 30%, then it got down to 20s, mid 20s. Now it's higher 10s, and this up until now is not even 7%. It is a rather questionable if the company would be able to sustain it, especially when it gets so big and the presence gets enormous globally. But for instance, we can take that. If we take, for example, the assumptions of Yahoo Finance and the investors and fund managers there, or analysts, we can also type in Netflix, and then we can, for example, check it here. So if we go to analysis, and then if we go to growth estimates, so next quarter I think it's going to be up 43%, next year about 29%, and in the upcoming 5 years about 24%. So this is similar to the historical growth rate for the past 10 years. So we can assume that this is going to be sustainable, and we can put in here 25%. Is it realistic? That's another question, but this is also something for you to keep in mind and to consider when you're going to be doing your due diligence. But we can assume, for example, that a Netflix would be increasing its revenue through other things, not only by creating more content and just increasing the number of users who would love to watch movies or series, but maybe some of you have seen that Netflix has introduced games in there. Maybe Netflix has some plans to actually make a subscription powerhouse. So combine, for example, in their games subscription, similar that Microsoft has, or Electronic Arts, right? Maybe they're gonna start introducing music subscriptions. Maybe they're gonna start also introducing sports subscriptions where you can watch football or NBA or any other sports, which everyone likes. And imagine if Netflix would become so strong that you would not need, for example, Spotify or ESPN or any other thing. You can just only buy Netflix, and you're gonna have everything in one package. To me, that sounds like a very good deal and something which potentially can become a very good growth driver for the company. So I don't have any insights. I do not have any people or friends who work at Netflix, unfortunately. But if that's something that Netflix's management envisions in the long term future, that could be definitely something which would support the assumption of 25% growth. So let's assume that, you know. When it gets to the PE ratios, which we expect to have in the upcoming future, you can also check it in the external source. So for instance, for this purpose, we use something which is called microtrends. So in here, as you can see, the company was also experiencing very turbulent moments when it gets to PE ratio. It was as high as 400 and then as low of 15, right? So in order to be rather realistic and assume that the company is actually gonna have very good prospects in terms of growth, right, and bringing in more content, not only, let's say, movies and series in there, but also something else, maybe we can say it could go to as low as 15% if things are gonna go very bad, because we also need to consider the macroeconomic environment in the upcoming years, which doesn't really show any good signs. But also it can have some upside. So something in the ballpark between 15 and up to 90, I would say, is rather realistic. So we can put in 15 here and 90 here. Required rate of return and discount rate, we would just usually prefer to keep it at 12%, just to have some of let's say premium versus just investing purely in S&P 500, which returns from 8 to 10 or 11%, I think. So just to have some premium is always not gonna hurt. And the margin of safety as well, this is probably, I would even probably increase it up to 30%, just because of the fact that the company is quite volatile and it still has quite competition, even though, let's say, Disney Plus and HBO Max is not doing very well, and some other competitors. But still, you never know, there might be some other market players trying to get the market share from Netflix as it was before. So just to be careful. And the discount cash flow formula, this one is also quite tricky, because 10 years is quite a big of a horizon, especially for a tech company. So I think I would rather stick to a 5-year horizon, just because there's so many things that can happen, honestly, and it's better to, at least nowadays, in my own opinion, just to keep it short term, which 5 years is still a lot, but you can always just do recalculations later on if you would like to. So then you would click the analyze button, and it's just gonna run some calculations real quick. In the meantime, I would also like to say that again, this is not a financial advice, so you'd better make sure that you do your own due diligence and maybe consult professionals if needed. But yeah, this is just, let's say, the tool which would help you start doing the screening process, and then you can just move on and just do the further research yourself if you get interested in a certain stock. So as you can see here, our valuation is actually quite close to the current price. So the average valuation is about 460 euros, dollars. And the target price is around $330. But this one just includes also the margin of safety. If we, for example, reduce the margin of safety, the target buy price would be a little bit higher. So yeah, Netflix is a very interesting case, I would say, because there's so much potential in the stock. However, paired up with economic uncertainty and plus quite some competition which is already exists, and it comes from the very established players, this raises some question marks. But for example, if you would like to keep these assumptions, you can always click save button, and then it's gonna end up in your watch list, and then you can make some notes, for example. And even better, there's another tab which is called valuation tracker. So in here you can keep your fair value of a stock, which you seem to have there, and then you can put in two angles to it. One is when the stock you would consider being undervalued to your taste, with a range in terms of percentages. So you can also adjust it, like for example, instead of 25 you would like to put 30 in there, and the same goes for the overvalued range, and that's how you can, for example, just effectively track all of your companies in a watch list. So if you like the tool, and if you like our let's say methodology with what we use, you might also get a copy of it, and you can just go to our website 930.com, and then you can just get access to the tool. It only costs $1 at the moment, or €1, which is super cheap, especially for the value it offers. We just would like to give that discount to the first 15 people who are going to join, let's say, our small community. And yeah, stay tuned. We have more exciting news coming up, more content for you guys. Please leave your comment. Let us know what you think. If you have any criticism, please feel free to reach out. We would like to address it, to make it better, to make it nicer, because yeah, our idea of all of this small startup is just make investing for ordinary people accessible and easy to understand. So yeah, stay tuned, have a good day, and see you later.